Hello and welcome. Coming up in today's stock analysis video, we are going to examine PayPal. During our stock analysis, we are going to explore the key pillars, examine the ownership, look back at past results. We also want to find out what analysts' predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally draw some conclusions based on our findings. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. Let's start by looking at the key pillars of a trailing 12 months. Within the first pillar, we want to explore the return, which helps indicate how good the management of the business is. So we'll look at the return on invested capital, which is a calculation used to assess the company's efficiency at allocating capital under its control. And we also want to look at the return on equity, which is a measure of the financial performance calculated by dividing the net income by the shareholders' equity. Return on invested capital is 14% and return on equity is 20%, and we'd like to see both of these over 10, so this is a great big tick for PayPal's management. And this indicates the company is working very effectively. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability than traditional earnings or dividend yields. It's based on the actual cash a business generates rather than reported earnings, which may be subject to various accounting adjustments. He typically looks for a company that has a free cash flow yield of 5% or higher. So at 5.94%, this appears to be a very healthy company. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is 40%, so we wouldn't want this to drop any lower. If anything, we would like this to go up in future earnings reports. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. PayPal's operating profit margin is 17%, and ideally we want this over 15%, so this is looking pretty good. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. In PayPal's case, this is perfect as it's 2.27. Last, we're going to look at short selling and see if any traders are expecting the share price to drop. So anything that is over 5% we would tend to avoid until the volatility has settled. At 1.98%, this suggests traders are not overly short in the stock at the moment. Let's take a closer look at PayPal's free cash flow, and we can see it's been a little choppy in the last few years, but it's still fairly healthy. PayPal has a large market cap, and Morningstar believe that they have a narrow moat, and they currently own 41% of the market. Now let's look at the ownership. There are currently 6 super investors who own this company. Most notably, Pat Dorsey has PayPal taking up 9.7% of his portfolio, whereas Mike Lindsell and David Rolfe have about 6% of their portfolios taken up with PayPal shares. And David Rolfe added 2% in the last quarter. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. As we can see, the share price was happily going up year on year and did particularly well due to the pandemic, but has since dramatically fallen from its high of $354. The question is PayPal a better company in 2017 than it is in 2024, as it has now reached the same price it was 6 years ago? So let's see what the analysts think. Richard Bowman, an analyst, believes that even with the competitive landscape, PayPal is 16.8% under its correct value. Although it is financially a very healthy company, it has a good past, its future doesn't look overly positive, and doesn't believe the company will become the growth company it previously was. Stefan Kalanick, sorry if I've butchered his name, believes that the company is massively undervalued and is capable, under new leadership, of becoming the growth company it previously was. And it would appear that other analysts are starting to warm up to the idea that PayPal can catapult itself back in favour on Wall Street with potentially huge improvement in growth. Now, in order to build a valuation, we need to look back at the past, but also decide on a possible future for the company. Let's look back for the trailing 12 months and see what insight this gives us. The PE ratio is 17, the earnings per share is 3.84, which is an 84% increase. Free cash flow per share is 3.85, which is down by 13%. Revenue is 26.89, which is up 13%. Book value per share is 19.2, which is an 8% increase, and the equity growth over 10 years is about an average of also 8%. Let's add some context to the revenue by looking back over the last 10 years. And wow, PayPal has continually increased its revenue year on year for the past 10 years. So why hasn't this been reflected in its share price? If we look at the revenue and expenses chart, we can see that USA consists of about 58% of PayPal's income, but it gets 42% from its revenue from other countries. At present, their biggest hindrance is cost of sales, which eats up nearly 2/3 of their potential gross profit. If this was streamlined, this would clearly improve their earnings. Here we can see PayPal's earnings per share. This was nicely improving from 2015 up until 2022, but has since recovered from last year's dip. Now let's turn our attention to the book value per share, and although this number looks good, it does appear a little stagnant over the last 3 years. Next we need to decide which type of valuation will be best suited for this company. A discounted free cash flow to the firm, a dividend discount model, or an earnings per share growth model. For this particular company, I'm going to use the earnings per share growth model. Now that we've looked in the past, let's project into the future. The question is Alex Chriss capable of shocking the world and making PayPal a growth company again? Now, Alex seems very capable, but is likely to make mistakes along the way. He will need to be able to utilize a company's assets and vast amount of data to ensure the business starts to implement his vision for change and become a growth company once more. So I'm going to use the current earnings per share of $3.84 as my starting point when creating a valuation. I'm then going to optimistically predict that the company will return back to its core values and therefore enter 12% growth for the next 10 years. As a rule of thumb, you tend to double the growth value when working out a predicted PE ratio, but for this valuation I'm going to enter a PE of 30. After that, we want about a 15% return on our investment, or at least I do. And I mentioned it before, we are going to project these numbers forward by 10 years. This then gives me an estimated value of $100 per share for its future share price. We then want to apply a margin of safety, which in this case I'm going to apply 50%, which gives us a price target of $50 per share. The current share price is about $64.77, but when it hit a previous bottom, it sat at about $50, so at this point I'm quite happy with the valuation. In this next section, we're going to split the chart into different zones of resistance. Our first zone is what we look back at being the market bottom for PayPal, which was about $50. We currently seem to be in zone 2, which is about $65 right now. After that, we identify zone 3, which is possibly going to be around $75 based on the lines of resistance when the stock was originally falling. And finally, zone 4 is where we identify our exit strategy, or at least the point where we want to take some profits off the table, which for me is about $90. In this next section, we're going to find out what our potential return would be if we bought at today's price. which is $64.77. If the share price was to hit the 52-week high of $77.95, we could see a return of 20%. Whereas if we were to hit zone 4 in our exit strategy, we could see a return of about 39%. PayPal isn't a dividend stock, so other than a token 10 cents per share, we're not going to see a big return on this front. Finally, let's draw some conclusions about what we found out about the company. The pros are the current share price, as it seems to have started to recover from the price drop that has occurred over the last 2 years. The shareholder metrics such as return on invested capital and return on equity are good. The change in CEO could well prove to be a major boost for the company and inject book value growth back into the business. As for the cons, there remains some doubt whether or not PayPal can get back to being a growth company. Are they going to be able to improve their operating profit margin? And although PayPal controls 41% of the market, it sits within a highly competitive area, and it may struggle to hold on to its narrow competitive advantage. What are your thoughts on the company? Is this an opportunity for you to own part of the business, or would you rather wait for a better price? Or would you like to avoid this company altogether? Let me know in the comments section below. Thank you for watching, and I'll see you in the next one.